Welcome to TradeLogAI Academy. In this lesson, we'll break down PnL logic, long versus short. You'll learn the exact rule for how each side makes money, how each side loses, and why the same price move creates opposite results. Let's start with the core idea. Before we talk long versus short, you need one core concept. There are two types of PnL. Unrealized PnL is the profit or loss while your position is still open. It changes every second as the mark price moves. Realized PnL is the final result after you close the position. That's the number that actually hits your balance. Simple analogy. Unrealized is your car's estimated value today. Realized is the cash you have after you sell it. Now let's define a long position. A long means you're betting the price will go up. If price rises above your entry, you profit. If price falls below your entry, you lose. So long is simple. Up is good, down is bad, relative to your entry price. A short means you're betting the price will go down. If price falls below your entry, you profit. If price rises above your entry, you lose. So, short is the opposite of long. Down is good, up is bad, relative to your entry price. Now let's set the baseline with a simple spot trade. You invest $100 in an asset. If the price moves up by 5%, your PnL is plus $5. Your value becomes $105. If the price moves down by 5%, your PnL is minus $5. Your value becomes $95. So in spot, PnL moves 1-to-1 with price change, based on your full $100 exposure. Now here's the amplifier. Leverage. You're still putting up $100, but this time it's margin. With 10 times leverage, you control a $1,000 position. So the same 5% move hits the full $1,000 exposure. If price goes up 5%, your PnL is plus $50. That's $1,000 times 0.05. If price goes down 5%, your PnL is minus $50. Same math, opposite direction. And here's the key. The larger the leverage, the smaller the move needed to seriously damage your margin. If the move goes far enough against you, you can get liquidated, meaning the exchange force closes the position and you can lose most or all of your margin. Next is the key distinction most beginners miss. Margin versus position size. Margin is your collateral, your own money at risk. In this example, that's $100. Position size is your total market exposure, the size of the trade you control. And the relationship is simple. Position size equals margin times leverage. So, if you use $100 margin with 10 times leverage, your position size becomes $1,000. Here's the important takeaway. Your PnL is calculated on the position size, not on your margin. That's why a small price move can create a much larger profit or loss than you'd expect from just looking at the $100 you put down. Now let's go from gross PnL to net PnL by accounting for the costs. Think of it like this. Gross PnL minus trading fees minus funding fees equals net PnL. Trading fees are the costs you pay to open and close your position. Every entry and exit has a fee. Funding fees are unique to perpetual futures. They're periodic payments exchanged between traders to keep the perp price anchored to spot. And here's the key point. Funding can be paid by you or paid to you, so always check the current funding rate. Bottom line, your true performance is net PnL, not gross PnL, because costs can quietly eat into your edge. Next, let's cover 3 common PnL mistakes and the simple fixes. Mistake number 1, treating unrealized PnL like safe profit. Unrealized PnL is paper profit. It only becomes real when you close the position. Mistake number 2, ignoring funding fees when you hold positions. Always check the funding rate. If funding is high, it can slowly drain your profit, even if your trade is right. Mistake number 3. Not knowing your position's tick value, how much each price move is worth. Before you enter, calculate exactly what a 0.1%, 0.5%, or 1% move means in dollars for your position size. If you avoid these 3 mistakes, your PnL tracking becomes more accurate, and your risk control gets much tighter. Now, here's a simple 5-step checklist you should run before every trade, so your PnL math is clean and your risk is controlled. Step 1. Confirm your direction. Are you long or short? Make sure the trade idea matches your bias. Step 2. Calculate your total position size. That's margin times leverage, because your PnL is based on the full position, not just your margin. Step 3. Identify your take-profit exit price. Know exactly where you'll lock in profit before you enter. Step 4. Identify your stop-loss price. Define the level that proves you wrong and cut the trade there. No exceptions. Step 5. Check the costs. Trading fees and funding fees can change your net result, especially on leveraged positions. If you do this checklist consistently, you stop guessing, and you start tracking true net PnL with discipline. To wrap up, the goal isn't just to make PnL. It's to turn PnL into a repeatable process. When you track every trade, you stop guessing. You see your true net PnL after fees, after funding, after mistakes. And over time, that tracking builds discipline, consistency, and control. That's exactly what TradeLogAI is built for. Track every trade. See your true net PnL. Build discipline.